Hello, and thank you for joining us today for this Edward Jones webinar, Investing and Emotions. My name is Sandy Miller. I'm going to be your host today, and I'm excited to have three industry professionals on our panel, and I'm going to introduce them to you in just a minute. But before we get going, let me highlight a few of the features on your screen that we're going to be using. On your screen right now, you should already see a video window with me inside. There should be another window with our presentation slides, and then a third window for our Q&A feature. If for some reason you have any difficulty during the program, you can click on the help icon at the bottom of your screen. That's the black question mark inside the yellow circle. This is for any technical questions you may have. We also have a team on standby ready to assist you if at any time during our discussion you have a question or would like clarification on a point. Just click on the Q&A icon, which is the third button from the left at the bottom of your screen. That will allow you to send in your questions. We'll do our best to answer your questions in the allotted time we're given. If your question is not answered, though, please follow up with your Edward Jones financial advisor. If you do not have an Edward Jones financial advisor, just click on the Find an FA widget below. We also have a lot of helpful resources and information available for you inside the Resources icon, which is located next to the Q&A icon. All right, now that you know your way around, let's get started. While we can't control uncomfortable market ups and downs, we can determine how we respond. Today, we brought together industry professionals to help discuss the current climate that could be causing your emotions to swing and what to do instead to help ensure a calm disposition and a more mindful investment strategy. I'd like to introduce Edward Jones Senior Client Needs Research Analyst, Megan Dow, Edward Jones Financial Advisor, Travis Lois, and special guest, Liz Kaler, Managing Director at Head of Advisor Insights Team at BlackRock. Welcome to all of you. And Liz, let's get right into it. Why are market swings occurring?
Thanks for having me, Sandy. It's an honor to be here. And absolutely, there are several factors contributing to market swings in 2022 so far, right? We've seen a combination of first, increased expectations for the Federal Reserve to raise interest rates. Second, higher and more persistent inflation. And third, now the war in Ukraine and sharply higher industrial commodity prices like oil. And first, when it comes to interest rates, right? Central banks have kept their policy rates pinned pretty close to zero throughout the pandemic to help resuscitate economic activity. The less expensive it is to borrow money, the more consumers, businesses, and governments are willing to spend and to grow. But inflation has reared its head for the first time in a while, reaching figures of up to 7% in some months. So Jerome Powell, chairman of the Federal Reserve, believed that they must raise rates to combat that inflation. Now, historically, raising rates can help fight inflation by dialing down an overheating economy marked by a lot of consumer spending. However, we believe that inflation today is largely being caused by supply chain bottlenecks following pandemic shutdowns, customer preferences for goods over services, and needing higher wages to attract employees to in-person essential jobs. So yes, we believe interest rates will rise because the COVID emergency may be over, but perhaps not as much as financial markets expect, right? Still, concerns that the Fed would slam the brakes to contain inflation has had an immediate effect on stocks as the cost of borrowing goes up and the ability for companies to invest and grow decreases ever so slightly. And of course, and most top of mind right now, the war in Ukraine. I want to first acknowledge that the situation in Ukraine is a humanitarian tragedy, and we are also doing what we can to provide support. But per your question, Sandy, this may be a harrowing time for a prolonged period, which certainly can spell more market volatility. We now face an energy and commodity supply shock on top of what we had seen with the pandemic supply shock, which means we will likely experience some weaker growth and some higher inflation than even had been forecasted just a few weeks ago. All of that said, and why we're here today, when it comes to investing, history has shown that even after major market drawdowns and declines, stocks can recover within a relatively short time frame, right? Therefore, we urge investors to keep perspective, to stay diversified, and to stay the course when it comes to your investment strategy.
Megan, I want to move to you now. Can you talk to us about the common reactions investors have during market swings?
Absolutely. But before I jump in, I want to make one caveat. When describing behavior, I'm going to focus on tendencies. As anyone who's interacted with very many people knows, there's no one rule where every single person responds the same way to a given thing. What we do know is that when we look across a population, there are trends or tendencies in how people behave. And when we see persistent trends, it's generally because these behaviors are driven by something very fundamental about being human. So what does this look like in financial markets, especially when those markets are trending downward? The first is that people want to leave the market. Losses are painful, and most people have what's sort of academically known as loss aversion. There's been a fair amount of research that shows that for most people, losses feel more painful than an equivalent gain feels good. So when markets are trending upward, it's great, but we often aren't really paying as much attention. When markets trend downward, all of a sudden we can have this very strong emotional reaction to a painful experience. And one of the immediate impulses we often see is to get out of the market, which makes it feel like we're stopping the loss. But interestingly, from a purely economic perspective, what we're actually doing is locking in the loss and not giving our investments the potential to recover. But in the moment, it often feels like the safe thing to do. Another behavior that's common to see, although I'll note that really we see this in any type of market environment, is chasing performance. We want out of the investment that looks relatively bad and into the one that's recently done relatively better. And there's lots of behavioral reasons that can drive this. It may be what's known as recency bias, where we overweight recent history because it's easy to recall. Somewhat similarly, it could be what's known as anchoring, where because recent performance is one of the first things we're presented with. I always think about my cousin talking about how his stock performance went up last year. We anchor to that. We forget that past performance doesn't guarantee future performance. And it really can be as simple as a phenomenon known as herding, where we do what we see other people doing. So when we see a lot of people either getting into or out of an investment, there's a strong social impulse to follow the crowd. All of these can influence us to think that investments are more predictable than they really are, and to chase the recent top performers, run from the recent underperformers. I know I've been throwing out some behavioral science terms, loss aversion anchoring, recency bias herding. Anytime I talk about these, I always want to just take a moment and put all of this in context, because sometimes I feel like this comes off as sort of an academic way of saying most people make bad decisions. That's really a narrow understanding of these tendencies and can make us feel ashamed when we struggle with them. When we look at most of these, there's a strong adaptive reason they exist. Thinking back on human history, if you're a part of a small community under attack from something threatening in your environment, herding is a pretty good tendency to have for survival. If you're dealing with an environment of scarcity, loss aversion comes in really handy. The challenge is that the modern financial system hasn't been a part of our environment very long, so a lot of these adaptive tendencies don't serve us very well there because they weren't developed for that. But it's important to keep in mind these tendencies, biases, behaviors, they do work really well for us most of the time, just not so much in finance. So they're nothing to feel bad about. We all deal with these to some degree.
Travis, what do you hear from your clients when the market fluctuates?
Sandy, that's a great question. And the answer is I hear a lot. For most of my clients that I've worked with for some time and coached on what's normal and what's to be expected, I hear things like, let's buy low. We knew you were going to be calling. A lot of times I'm actually hearing excitement. But there are others that say things like, I'm worried. Should we be worried? The news says this. My friends say that. I think this is going to happen, or I feel like that's going to happen. I've lost X number of dollars. For these folks, it's definitely stress and fear.
Yeah, understandably, a lot of emotions. Now, we all know that being aware of situations like this doesn't always translate into making better decisions. Liz, what are some tangible things one can do to kind of ease their mind?
Sure. We've talked about this, right? It's important to try to separate our emotions from our decision-making, as difficult as I know that can be at times, and especially when external factors around us are challenging, like they have been, right? It can enhance that fear of loss that we're talking about, that we naturally have with our investments. And all the media, by the way, that we're constantly bombarded with doesn't help. It can actually fuel and be the cause of some of these feelings. So the big takeaway here, we don't have to be smarter than the rest. We have to be more disciplined than the rest, right? And taking action or trying to fix your investment portfolio often leads investors to try to time the market. But what's interesting, a reality to consider, is that 24 out of the 25 best days in the market came within 1 month of one of the 25 worst days in the market over a recent 20-year period. The point is, if we overreact to any one bad day, we could really miss out. And because we can't predict when those best days will be, staying invested is oftentimes the best strategy, right? It's all about time in the market, not timing the market. And this was especially critical, by the way, at market lows in 2020, right? Investors who were focused on their goals and less about what the market was doing likely did better than those who reacted out of fear, right? And also, it is so important to diversify. A diversified portfolio can be difficult to own, right? Sometimes it never quite feels like you're ahead. We start to wonder to ourselves, why am I still losing money in a market downturn? I thought my portfolio was diversified. Or why does my portfolio always underperform stocks? Am I missing out? But if you add up all of these periods in the market, the diversified portfolio works because when it feels like it's losing, it's earning more by losing less, right? So it's also important to remember. And finally, experts typically suggest that when you're trying to break a bad habit, it's extremely helpful to tell someone else so that they can help hold you accountable, right? And when it comes to investing, the perfect person for that job is a financial advisor. Just as important as managing your money, they act as an intermediary, a stopgap, if you will, between you and your investments, and can help you avoid some of those common mistakes. So talk to them about your goals, trust their experience in navigating markets and managing risk in your portfolio, and making that emotional roller coaster a little bit smoother, a little bit less volatile for you. It also helps to establish some guidelines that can be followed to stop any impulsive actions.
Travis, I'm sure you've played this role for clients. How has it helped them?
Well, I like to think of myself as a financial coach for my clients. Now, when you hire a coach, you're not paying somebody to pat you on the back and tell you that what you're doing is perfect, right? You hire a coach to help you to identify what you can improve, the changes that you can make to be better. I work very hard to understand what is most important to my clients, and I use that as the foundation to be able to coach them through a lot of what we experience. Now, when things get tough, or you turn on the news and it sounds like the world is ending, the coaching I provide my clients on how to do better, what to pay attention to, and sometimes what to ignore, it helps them to achieve better results and keep them focused on what really matters to them.
I think that coaching role is so important. I think a key part of it is serving as an accountability partner, like Liz was alluding to, because our behavioral tendencies, the ones that work well most of the time, because they're adaptive, because they're so fundamental to simply being a human being, it's really difficult to just think our way out of them. In fact, there's a body of research showing that when people are educated on these, they don't necessarily make better decisions. They just become better at justifying the decisions they want to make. So having an accountability partner or that coach can be huge when it comes to making better decisions. And I don't want this to turn into a commercial, but I'll reiterate the power of that accountability partner being a financial advisor like Travis. Having an independent third party who you trust and is knowledgeable about financial markets and decisions, who can watch out for your blind spots, that can really increase the value that accountability partner, that behavioral coach is bringing to the table for you. Going back a bit, the other thing Liz mentioned that I'd kind of like to build on for just a second is diversification, because I know it's one of the first things drilled into anybody navigating investing. But part of the reason I find it so fascinating is because despite it being such a basic concept, it's one of those things that's behaviorally really difficult to execute. Staying properly diversified means holding on to investments that can feel like they're dragging you down, and that's not an easy ask. I'd like to use an analogy of packing for a multi-day hike. Especially in certain climates, you pack for sun, rain, wind, and snow. And at any given moment in the hike, there's something you're carrying that's probably not serving you well, but you want to be prepared for whatever conditions you might encounter, especially when those conditions can change on a dime. And diversifying your portfolio is the same idea, where you're selecting and holding investments that should help you weather a variety of market environments more comfortably, hopefully limiting that pain that comes with loss aversion to something that's tolerable for you. In addition to the points Liz and Travis made, if I can add one additional strategy, and to be honest, it's one of my favorites because it's worked really well for me in the past, you set up a rule for yourself, and this is best done ahead of time, that creates friction between a strong emotion and a financial decision. For example, you promise yourself you won't execute on any large financial decision until you've had a night to sleep on it, or 3 days, or a weekend. really whatever you think you can reasonably follow through with. And that gives you some time to work through any strong emotions and consider the decision in a more cool and rationally driven mindset. Like I said, something I've had success with, so I always like mentioning it for anybody that's kind of up for trying it.
Sounds like good advice. What other behavioral changes would help, Liz?
Sure. As we mentioned, no one can predict what will happen next in the markets, right? Not even expert analysts on Wall Street or TV. In a survey, only 43%, in fact, predicted whether interest rates would go up or down. That's less than the chance of getting heads on a coin flip, right? We know we can't control the future, only ourselves and how prepared we are to face it. So yes, I'd advise you to perhaps limit some of your TV watching, or at least don't overweight what some of the news sources are telling you. Another example of how the emotion of envy can get the best of us, right? Why are we willing to play the lottery even when we know the odds aren't in our favor? It's because we're often willing to accept a high probability of poor returns for a small chance of earning large returns. This is often called the lottery effect. It's why investors are willing to concentrate positions in single stock issues or invest in the next hot startup. Could be a company, could be an investment trend, right? The excitement of large returns can cloud our better judgment, and sometimes we can make poor decisions. So remember to just try to recognize some of these common emotional and behavioral mistakes that we're highlighting today, and our tendency as humans to repeat them. Be willing to be critical and disciplined about your own approach, even when times are good, and opportunistic when times are bad, right? You're investing for the long term, so don't try to time the market, and try to resist the urge to check your portfolio too often.
Travis, I want to move to you now. What guidance are you offering your clients?
Well, first of all, I remind my clients that we are not day traders. We're long-term investors. As long-term investors, we don't need to be concerned with short-term fluctuation. We're concerned with what do we need to do to keep your dollars as productive as possible throughout your life in support of your goals. Strategy always wins over guessing games when it comes to making good investment decisions. Now, as long-term investors, temporary downturns actually present great opportunities that we can take advantage of in support of those longer-term goals. I work with my clients to help them to think of downturns as an opportunity to go to the clearance racks and buy the stuff that we really want, but at a discounted price. I also remind clients that it's not always about the account value. That's going to fluctuate over time. It's really about getting the income you need to achieve your goals. Most often, if your goals haven't changed, your strategy shouldn't either. Adjusting your mindset to see things from this perspective can help you to avoid many of the common mistakes and pitfalls you'll be presented with over time.
If someone's goals haven't changed and their strategy looks good, do you have any suggestions if they still feel anxious or unsettled?
Yeah, sometimes, especially when we're faced with uncertainty and a lot feels out of our control, we quite simply feel the need to do something. And if that's the case, it's just about finding a productive something to do. And, as I mentioned before, your first impulse may be to get out of the market, but there's a lot of other actions to consider that might better position you for your long-term financial goals. So one of the first one that comes to mind for me, and this might be too much of a swing in the opposite direction for some, but rather than getting out of the market, I'd look at if I can put money to work. Travis was just talking about that. See if there are areas you can cut spending and potentially increase your savings rate. Market downturns have historically been great opportunities to buy. Liz noted 24 out of the 25 best days in the market came within 1 month of one of the 25 worst days in the market. And Travis talked about his clients that get excited to buy low. It's a great option if it's something that you're capable of doing. If not, something else to consider, talk to your financial advisor about rebalancing. Market movements can cause your mix of assets to get out of balance. You can see if it's a good time to rebalance to help ensure you're taking an appropriate amount of risk and you're properly diversified. Another thing to consider, if you've got taxable assets, you might want to talk to your tax professional to see if strategically realizing gains and or losses could be beneficial from a tax perspective. And there's lots of other options you can explore. Sometimes, though, we really have taken on more risk than we can stomach. And if that's the case, Rather than de-risk all at once, potentially while the market's down, consider putting a plan in place to de-risk over time. This essentially adds a sort of time diversification to repositioning your portfolio. Regardless of what you might be thinking, your financial advisor can help you revisit your goals, assess how much risk you're comfortable taking, and run scenarios to highlight the effects of any changes that you might be considering making.
And Travis, how do you help clients take that productive action?
So as I mentioned, as I coach my clients, my job is to find ways they can be better. So we don't only have conversations about their strategy and reasonable expectations for what their portfolio will do over time, but I'm proactive about reviewing their plan and reaching out whenever there is something that we can be doing better or taking advantage of. When they call me with questions or concerns, we talk through it. We look at what the research says about what's normal and how to be successful at investing. Generally, I'd say these interactions happen at least quarterly, sometimes a lot more often.
All right. Well, I do want to get some final thoughts from all of you today. Liz, I'm going to start with you. What's your final thoughts for us?
Yeah, thanks again for having me. In summary, how we behave has a huge impact on how our portfolios behave. And often the more we try to step in, the worse we can sometimes make it. So spend time thinking through communicating your personal and your financial goals with your Edward Jones financial advisor, because they can help you ensure that you're on track throughout all the market cycles, right? And you can also look at some of BlackRock's one-pagers available through your Edward Jones financial advisor to engage in conversations around avoiding S&P envy, right? Keeping more by losing less, or how to avoid some of the costs that come with investing with our emotions. And look, if recent events have reminded us of anything, it's truly how important our friends and our family are. And so do what you can to mitigate your emotions and the impact they have on your investments so that you can save them for when they really matter, right? With the people who mean the most to you. Thanks
Well
again.
said. Yeah, well said. Megan, final thoughts from you.
There's a lot going on in the world right now, and it certainly impacts our finances, but it can also impact our well-being. For most of us, money is a very emotional topic. It's as much about safety, security, anxiety, freedom, as it is about dollars and cents. And that's totally normal, but doesn't necessarily make it any easier to cope with the strong feelings it sometimes elicits. I hope we've provided some strategies today to help, and sincerely thank you for sharing your time with us and trusting us to help you navigate such a sensitive topic.
And Travis, final thoughts.
Thanks for having me, Sandy. Listen, always remember, market fluctuation and downturns are normal and to be expected. Don't make long-term decisions based on short-term situations. Your long-term investment success will be enhanced by having a good strategy and sticking to it.
Well, I know I feel better today. Thank you all so much. We appreciate your insight and your tips today. Thanks again. And as I mentioned earlier, we have several resources that we hope will help you during this time. Be sure to check them out by going to the resource icon on your screen. We're now going to start the Q&A portion of the program. We have a team of subject matter experts waiting online to help you answer your questions through the Q&A widget. Please remember that there will not be any video during this portion. You will only see a slide prompting you that the Q&A is now in session, but rest assured the webinar is still live. We'll do our best to answer your questions during the allotted time. If your question is not answered, though, please follow up with your Edward Jones financial advisor. If you don't have an Edward Jones financial advisor, please click on the Find an FA widget below. I also want to remind you that this broadcast will be available again on demand using the same link you used to register for today's program. And please note our upcoming webinar as well. Thanks again for joining us, and please enjoy the rest of your day.